The Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH, this is Carrie Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote.
Hello everybody, welcome to another edition of the Value Guys Stock Talk Show with Val Hughes
and Momentum.
And we are 31.3-year Wall Street veterans who have had to take on secret identities and go underground in order to provide you with our candid views on a handful of stocks we screen for each week here in our Value Shop. You've seen our faces on TV, you've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week, it's May 11th, 2012, and we have done a value screen, small cap value screen this week based on a ranking of low PE stocks that have good balance sheets. But before we get to that, a couple of important caveats. And I can't say these too strongly, Mo. First, this show is for entertainment purposes only. It's not a guarantee. Secondly, this is a hobby for Mo and I. We are professional Wall Street analysts during the week, and we do a lot of careful fundamental analysis and talk to competitors and managers and etc. We don't do any of that here. Third, what's the third one? Kind of forgetting it.
We've been drinking.
Yeah, we've been drinking. Now, usually that's fourth, but it made me forget the fourth one, which is we may not have your best interests in mind, so certainly do your own work. We may be accidentally recommending you do the opposite of what you should do,
or intentionally telling you to do something.
Well, I wouldn't do that.
I wouldn't either.
So see all of our caveats at www.thevalueguys.com, where there's links to old shows, photos our moms took. I think you put a diary up there or something like that, didn't you? So those were hard times. Anyway, and we also have a best ideas list there, and importantly, something new.
The worst ideas list.
Yeah, did you put that up?
I did. I just posted it.
Well, I didn't see that one, but no, we have a new thing going on where the Value Guys are actually on YouTube. Now, before you run off there to see the Value Guys, it's just a picture of us, so it's not. I mean, but anyway, thanks to Carrie Lutz and the Financial Survival Network, they've put us up on YouTube, so go check that out. And there is a link to it on our site at www.thevalueguys.com. Okay, we've got 3 pretty good value ideas this week. If you tune in here, I don't know what you're going to get each week, but you'll get one thing for sure, and that is 3 pretty good value ideas, I think, oftentimes, small cap. And what we've been doing the last couple of months is we've been using the screens we use here in the shop. So we've got a couple small cap value strategies here. And we do things like screen on, what you might think about. Low PE, low enterprise value to sales, low price to book. But we've also done some other things, which is look for good return on asset stocks and then rank them on valuation and go through them. The point is, you're looking for an inbox of things to work on. There's no black boxes that spit out the 10 stocks you should own or anything like that. You got to go through these things one at a time. And this week we're back to one of the screens we did about 2 months ago. It's simply, and we did this in Yahoo Finance, which is free. You can go there and do it. Low price earnings on next year's estimate, which is probably a first call median estimate. Market capitalization below $2 billion. So companies that are worth less than that. Now, that might seem funny that that's small, but it is. And then we threw a little debt to cap filter on there. I think I've said less than 40% debt to equity is what Yahoo lets you do. So there's 3 names this week, and let me tell you what they are. Firmenite, ticker FRM. Krispy Kreme, that's one of yours, Mo.
That's one of my names.
And then that's KKD, if you're looking this up at home. And then finally, Standard Motor Products, ticker SMP. And then I think this week we'll do the stocks, and then we're going to get back to what's quickly becoming one of the favorite segments on the show. And in part, I think that's because it's the only segment on the show that we do, but it's called Walking Through National Economic Trends.
Right.
And I have it right here.
Right.
So that'll be at the back half of the show. So let's kick it off with our first pick. We're going alphabetically this week.
Before we do it, I want to quickly ask you a question.
A question, Mo?
A question.
All right. I hope I'm prepared.
It's a macro question.
Okay. All right.
Based on our low PE screen.
I don't know. I'm sorry, wait, you weren't done? Okay, I'm with you.
I have a question for you.
All right.
Based on your low PE screen, right?
Yes.
You generated a list of 95 companies, because I just counted them.
Mm-hmm. Mm-hmm.
Of that, 17 of those 95 companies that showed up on this screen had the name China in them. That's 20%.
You know, no one trademarked that. That's why you see that. Otherwise, people couldn't do it.
Why is 20% of the best PE stocks in the universe that you can pick out, why do they all have China in them?
Mo, are you trying to stump me here on the value? Okay, I'll tell you why.
I'm asking you a question.
I think I know the answer to that.
Tell me.
All right. What we do, we meet managers during the week. They come in here. We don't discriminate. Some firms, they'll only see a management team. They'll look it up. They'll carefully look. I don't think this is quite the right valuation. I'm not going to be looking at them. Well, you know what? We're a school here. I'm an idiot. I want to learn. Always. So, if somebody wants to bring their management team in here and make a pitch to us, we say yes, just to everything, because I have that sort of educational thought. Well, just like all these stocks on here are Chinese, for the last 2 or 3 years, Mo, I don't think it's half, but I'm going to say 20% of the invitations that we get to have people come in here are Chinese companies. And they're not themselves. There's brokerage firms that kind of specialize in that, and they're oftentimes West Coast, guys, because they're closer to China, I guess, Okay. And so if you look out the window here, you can see boats of stuff coming in from China, and a lot of them say China right on them. So you can see it right here. And I think what's happened is over the last couple years, there's a sense that China's doing well. They're in the ascension. It's in the public domain. Everyone's China. So there is an element of publicity. There's been a lot of publicity.
But if it was positive publicity, they wouldn't be showing up on the lowest part of the PE.
No, I understand. So I'm meandering to my story here, so a little bit. So there's a lot of Chinese interest. There's a lot of interest in China. And so you got these Chinese companies, they want to get in on it. It's popular. So all of a sudden, all these Chinese companies start showing up. And, people think China's growing and all that, so they start buying these Chinese companies. Okay. What happens? Well, it turns out that a lot of Chinese companies, you're not going to believe this, Mo.
I think I know where you're going with
you are not going to believe. A lot of these Chinese companies,
don't tell me.
They don't tell the truth in their financial statements. No. It's shocking.
Really?
And appalling. But a lot of them get caught in, let's not sugarcoat it, fraud and lies. Okay? Now, one bad apple doesn't make the whole barrel bad. I'm going to give you that. But if it's half the barrel, you really don't know which apples. If it's one, you're going to take a bite, right?
Right.
You'll still have a bite.
But if it's
half, you're like, I need to go to a different store. So what's happened is, just babies out with the bathwater. People look at an earnings estimate on a Chinese company.
They don't believe it.
And they just divide it by 10.
Well, don't you think that's a great value area to say, I want to get a guy in the firm that's going to go to China. Yeah. I'll do that. Hire me.
Will you?
Yeah.
What about you have a job that's pretty good now.
I know.
That's amazing. Wow. Well, we have an exclusive here on the value,
the ability,
guys.
I'll go to
one of the leading somethings in
the
Wall
something
Street
area
wants to join up with our little humble shop.
I think
I'm
it'd be great.
shocked. Wow. Put that in writing. Anyway, here's the thing.
Sounds like fertile territory.
We could work on something together.
Sounds like
you
fertile
know.
territory.
But I think that one thing you don't have in China. I mean, you have enough problems with it in America. Is you don't have information. Even if you go to China, there are firms that specialize in ferreting out this fraud. They go there. They have cameras. They put up YouTube videos. I mean, there's reports. I don't want to name any, have a favorite, but there's specific reports, and they don't always get it right. This is it's Wild West. So as a result,
low P's. Got it.
Because no one believes them. So our first Chinese company today.
No, we don't have a Chinese.
No, we're not doing a Chinese.
We do have a company, if we want to kick off with that. Firmenite.
Yeah.
So, I have a question for you.
Sure. We're doing Firmenite first.
Firmenite first. They provide online services.
Yeah.
That's a big area.
E-commerce, my friend.
Well, online services such as...
we're just reading the 10K, right?
Leak sealing. So I'm wondering, wow, this is amazing. Now, I've seen a lot of online stuff.
Yeah, it's all going e-commerce, my friend.
But leak sealing?
Yeah, they fix leaks.
Composite repair and valve testing.
Yeah.
And they do it all
online. Yeah.
Now, the only thing that threw me, which I thought was great, this company was founded in 1927, which was before you could seal pipe leaks online.
Now they're a little ahead of the time. They have evolved. They've clearly evolved because back then they just did online. They just did leak sealing by telephone.
Now they do it online.
Yeah.
But they still
by the mail. Originally, they did leak sealing by mail. By mail.
So this is just an update of the old business
it's still the
plan.
Same model.
Makes sense.
But now it's online.
Well, now that I understand what they do, I got to tell you, I kind of like the chart.
Yeah.
You know, it looks from a purely technical standpoint that they're, if they can hold this $4.50 level, you're at a fairly clear support level. I would watch it for a while. If it starts to bounce from here, it's been a little bit of a tear.
Let me get into this a little bit because it may seem like we don't know what we're doing here. And that's right, of course. But we did choose this out carefully. And here's the story on this. First of all, no one's ever heard of it. Right? You're a professional. Have you heard of this? No. They've got a
30 analysts follow them.
They've got a $160 million valuation. That's tiny. I mean, these three analysts, I can tell you, are most likely from firms that we've never heard of, and we've heard of a lot of firms. This is tiny. So that means less information in the market. It means opportunity to have some proprietary information. So I keep looking right there. Small. Then I'm going to look at the valuation. 7 times EBITDA. Okay. That's flip that over. 1 over 7, 14% cash on cash return. The long bond at 2. So I keep looking. I like that. Balance sheet, 20% debt to capital. Pretty good. EBIT margins, 9%. So they have enough money to cover their interest. It doesn't show the fixed charge coverage here, but if you're at 22% debt to cap and you've got a 5% interest rate, which I'm sure you don't, then you're paying, let's see, what's their cap here? Well, assets $200 million. Let's just start with that. 22% of that, $40 million. 5%, $2 million. And their EBITDA margin is 9% on sales of $300 million. So they have $30 million roughly in EBITDA and probably a couple million in interest. So well covered there, very safe. And this description we were talking about, it's funny, but I think what this means is if you're a manufacturing facility and you cannot have any downtime, why? Because it's money, right? They must have some sort of sensor or who knows, some kind of equipment to know when this is happening, or maybe there's an online access to calling someone to come fix it immediately, or maybe you have a device on your screen that automatically seals things. I don't know. Obviously, you have to look into this. But the fact that they point out that it's online it just suggests to me that they've got a very nice dashboard to whoever's in charge of that facility to manage all the maintenance of the thing, and that's going to be better than having a guy walk around with a clipboard and figure out if your factory is working. They've got pretty stable margins. If you ignore the recession year, they did dip from 10 to 3, but then right back to 9. There's an estimate this year of down a little bit, but I don't buy that. Analysts honestly don't know what those numbers are going to be in advance. The sales, since the recession have been consistently up. Again, the estimate for this year is very modest growth, but you have 3 guys that no one's ever heard of, so I'm going to guess that, they're young and they probably are just being super conservative and, who knows, but that's certainly worth checking into. And at 7 times EBITDA, I think maintenance is something that you can often think of as an annuity if you're doing a good job. And I don't know what their customer turnover is, but you'd want to know that, and that kind of thing. But maintenance with pretty good returns. They're doing, they did a 12% return on assets last year, 20% return on equity, 7 times EBITDA on maintenance business, good balance sheet. So I'm sold. That's my pitch, Mo.
I'm just throwing them. Yeah. Here's a mechanical thing to think about too. If you look at the average daily volume of this stock is 123,000 shares. I mean that won't generate even at the retail level $2,000 a day in commissions. So no brokerage firm really is going to pay attention to this, which is why you've only got 3 analysts following it.
Yeah, who knows who those people are?
And so there's always that possibility that when you're trying to find something that's undiscovered, look up at the number of analysts that are following it, because that's listed on every website or whether you're on Yahoo Finance or whatever.
They have it.
The fewer the analysts, the more likely you're going to be at least treading an untrodden territory.
Untrodden?
That's a technical term.
Okay, so that's Firmenite.
Next up.
Now you've got one here.
Krispy Kreme.
Yeah.
Love this.
Yeah. You do?
Well, we play a lot of in our shop. We play a lot of big picture, sort of macro trends. We think if you get on the right wave and it's big enough, no pun intended, given our next name. If it's big enough, then the odds of making a mistake by choosing the wrong stock are minimized. So we play big long-term trends. And one of the things that just came out a week ago. Center for Disease Control in Atlanta, major report comes out that in 2030, that's 18 years from now, 50% of the population is going to be obese.
Obese, yeah. Well, how are you going to get there?
Krispy Kreme, and that's the thing.
Playing right into that
it's a big trend. It's a macro trend. Macro, no pun intended. You get a macro trend. It's a big idea.
Like your cell phone idea from earlier, or I guess it wasn't on the show. But play into a trend, take advantage.
And
is there any food that has more fat content per weight than a donut?
That's the beauty of Krispy Kreme. Is a pure play in the group. It's the most direct infusion of fat, salt, and sugar of the group. It's true. It is delicious, but it has the best numbers out there to play to this trend.
Yeah. Well, what about the valuation or the competitors? I mean, aren't other people into this donut thing? Or?
Starbucks, come on, it's a different zip code. Einstein's Bagels, these guys don't get it.
No.
This is a niche group. They own it. If you're going to look at sprinkles or cupcake companies like that, it's a different thing. Absolutely. So I like that idea. And take a look at this. These guys, if you just look down at the EBITDA margin, the EBITDA margin's gone from 7.2 to 8.7 to 10.4. So they're obviously tweaking something.
Yeah.
The sales have been going up 5%, 11%, 10%. In the last 3 years, but they're tweaking the business somehow to
maybe
get
a little better pricing, higher end. Maybe they're also selling a coffee, something like that. I don't know that.
So these guys burst on the scene in 2006. They
People
had huge
love them. You
sales.
couldn't get in there. You were lines out the door.
But they were oversold. They were overextended. And look at the.
I remember this. They had problems. Big problems.
A few years ago, too quickly.
Guys went to jail. Right? There were in that whole options thing or something. Krispy Kreme, right?
And they had expanded way too fast. So you look at these sales: 460, 430, 280, 340. I mean, the sales were heading straight down through 2009. Sounds like they've cleaned it up. Revenues are starting to take off. Margins are definitely expanding. And their long-term debts declined, and their cash has doubled.
Yeah.
So
That's a nice one.
So, there are enough. And plus, I love the big trend.
Well, the big trend is coming.
And
they're a contributor, no question about it. I mean, the thing about it is, here's what I'd add to that. And I don't go to Krispy Kreme that often. I mean, but when you do, you're glad you did. But here's what I'd note. There's a couple of foods, like when you go in the elevator, so you head down, you get something, you come back, and there's two different things where if someone just before you had this in the elevator, you can identify it by brand. One of them, McDonald's. If someone was in the elevator just before you, you're riding up in the elevator, you can smell that there was a McDonald's bag in there.
Yep.
And the other one, Krispy Kreme, my friend. If someone comes up with a bag of Krispy Kremes...
Really?
Yeah, and I think there's something to that. I mean, it might be funny, but no. I mean, they are branding smell with their own distinct smell. And honest to God, I can't name another food or branded food other than McDonald's.
A scent, even a scent. Any
well,
scent.
I mean, perfumes you can tell.
I guess. Yeah.
But, coffee, Starbucks, can you tell the Starbucks from the the Dunkin' Donuts or the other? I mean, you can. Yeah. I mean, I don't know. But Krispy Kreme, I think they're getting you in all senses.
Wow.
Yeah.
That's amazing.
Yeah. So anyway, Krispy Kreme. Okay, one more. We looked through a lot of names.
This is one without a Chinese name,
and it didn't have a Chinese name, and we liked that.
Well, let me ask you a question about it.
Standard Motor products, by the way.
Gotta love this. Talking about big trends.
Cars, yeah, they're coming. Everyone will have one.
These guys make replacement parts for motor vehicles. So I had asked you before the show, I would have thought big trend, this would be a great company to buy because you would think that people are probably going to hold on to their cars a little longer and be repairing them instead of just trading them in.
Yeah.
But you were telling me before the show that car sales are up.
Well, we've mentioned this on the show. The economy seems to be doing a little better. And, there's cycles and there's newspapers that have to sell and all that. But generally, things are repairing. There is a natural repair cycle, and we're kind of in it. And one of the drivers has been, as confidence has come back a little bit and interest rates are so low, is autos. So when we were walking through national economic trends, and we'll see it today, although we don't have to comment on it, auto sales this year up 40% versus last year over the same period. Now, up until that happened, all I was saying is the fleet of cars in America had gotten the oldest that it's ever been. And, of course, there's a couple reasons for that. One is cars are better than they ever were, so they don't break. You don't need to change your oil as much, or if you don't, your car's okay, your tires last. These cars are so well built nowadays. So there's that element. But the other element is that people weren't buying cars to the same degree, and no one knows why. There's certainly an economic element to that. Styles are still changing often, so there's one thought that cars, back in the 40s, 50s, even 60s, cars were the coolest thing around in the neighborhood. But now they're not. It's other stuff. It's computers or technology. And so those teenage kids who couldn't wait to get a car to work on somehow and all that, and that's all gone. So that could be one theory. But the point about
how do these coexist? You've got a growth in the new car market, and theoretically, you're also seeing a commensurate growth in the replacement market. So they must be able to coexist and both grow. They're not growing at the expense of each other.
Well, if the average car, and I don't know the number, you have to go check it, but I think the average car in America is something like 8 or 10 years old now, and it used to be 6 years old, because cars would just break down and rust away. Now they're better, and so that means if the average is 11, it means you got some new cars at 1 and some old cars at 19. I mean, I have a 20-year-old car that I keep in the garage just because
I have a 30-year-old wife, and I let her in the house.
Yeah, absolutely. I take it out a couple of times a year, and I'm sure you do the same thing with your wife. But in any case, the point is that these cars, even if you have a big surge in, the first couple months this year, the average isn't going to go from 11 to 3. It's going to still be around, 11, 10 and a half.
Theoretically, that's an advantage for a company that does replacement parts.
Because, they're going to be in demand. It's more of an annuity. And so you know where your next sales coming from. It's from that car that broke down.
No. Again, I'm always looking at this from a big picture perspective, but I agree. The aging of the automotive population. Remember last week we did the replacement parts for old people. That medical products company, and it was the same. It was the same thing.
Same idea.
They're living longer, which means they break down more. So
the average age is older.
All that stuff.
Absolutely.
Same idea in the motorized world.
I agree with that completely.
I love it. So,
people want to maintain this. And let's get into some of the numbers here.
Tell me.
Because we're just talking conceptually at this point. It makes a lot of sense. All right. Well, look, 4.6 times EBITDA. Now, if EBITDA is trying to be a cash flow, earnings before interest, taxes, and depreciation, it's trying to be cash flow. Now, granted, you're going to have some capital spending. You're going to have to invest in some equipment, plant equipment, stuff like that. But arguably, for you theoreticians out there, capital spending is a net present value positive event, right? Should be, unless you're a bad manager. So if it's a bad manager, why are you buying the stock? Okay, so I've got you on that one. Probably a good manager. He's spending money, net present value positive. Why are you subtracting it? Okay, point 1. Point 2, did I have a point 2, or maybe I just had a point 1?
But the CapEx was $8 million.
Yeah, so that's not a lot. So I'm going to take that 4.6, and I'm going to do the inverse, 1 over 4.6. That's 22% cash-on-cash return. And you're just, the rub on something like this is in auto parts, you're lucky to get a GDP type of growth rate unless you're acquiring people and all that, which they very well may be doing. I don't know. They do $900 million in sales. Is there more? What's the addressable market? Is it 10 billion, or if it's 1 billion, then they're there, right? But I don't know that. But it looks like they've been kind of, in the years they do grow, they put up, there's a 10% year here. Here's an 8% year, there's a 3%. So it's going to be single-digit growth, but you've got that 22% cash on cash, a couple percent. It's a mid-20s total return, in my opinion.
Well,
and, that's why I like it.
Here's another thing: 2.7% yield.
Yeah, I didn't even mention that.
Yeah,
that's like for free, right?
That's for free. So I looked at that, and the other thing is there is a chart which you can't see, but we've printed out. And it says it's breaking down their total revenues, and one is engine management, one is temperature control.
Yeah.
But the third category is called European Group, and right now that is 0% of revenues. So the thing that intrigues me is if that is a new division which is yet to make a contribution to any of the total revenues, they're entering Europe.
That could be a positive. Well, I hope it's not an old division, because then it's been a complete failure.
Well, one would want to find out if that was...
Hey, how's old Jim doing down there in the European group? How's his group doing?
Well, we don't talk about Jim anymore.
Jim's gone.
But you would want to know whether that European division was
that's interesting.
Past tense or forward-looking.
Yeah. Well, they're out in, they're in Long Island, New York.
And they have 3,400 employees, so it's not a little company.
The company was founded by Elias Fife and Ralph Van Allen in 1919. Yeah, amazing. So that's that. Okay, so
drum roll.
Yeah, drum roll. We're coming to a very exciting part of the show. I can't even talk about it. That's the part of the show where we pour some more vodka, right?
Yeah.
Or no?
Don't hold that lighter over your head.
Okay.
This is flammable.
We're going to do walking through national economic trends. Now, the problem with that is we haven't actually yet walked through. Okay, we're back with...
We are.
Yeah, well, that was fun. So we're back with walking through national economic trends. This is the issue from today, Mo. Today.
Technically, aren't we talking through economic trends?
Or paging through. I got the name wrong. We're paging through.
Okay, yeah. But we are talking through them too.
We're talking through it and paging through it.
But we're not
walking through it, literally. Now, okay, this is available, I talk about this a lot, at the Federal Reserve of St. Louis.
They also have
the stuff free.
they have an app for your iPhone.
And they have a deli, but aside from that, yeah, they do have an app. And it's free, and it's got all the stuff about the economy. So we just go through it.
Some of it's interesting.
Page 2. So, okay. So I'm on page 1. That's just the title. So there's nothing really there.
Why is it the Federal Reserve Bank of St. Louis and not New York that does this? They have more time on their hands?
There is a story. I think all the feds, they all wanted to find their own thing that they did that was special so that the government wouldn't close them down.
Really?
Yeah. And they needed to have a reason to live, And I'm not sure what the Federal Reserve does in other cities. Honestly, I don't. I know Washington, familiar with that. New York, I don't know what they do. You ever go down there?
No.
I don't know. But these guys, they got a monopoly on the publishing of
economic trends.
National economic trends. I think.
But if they're giving it away for
coup.
free, how do they make money? That's a government agency. It doesn't matter.
Make money.
Yeah, it is a government agency.
Okay, so
first page.
First page is the title. Second page. All right, I'm on page 3, and you can page along. They have a chart of the unemployment rate. And people know this. I just think it's worth talking about. The unemployment rate peaked in the roughly third quarter of 2009 at 10%. And there's been some, rocky, trading ranges here. But it's basically going down, and it's accelerating going down right now. It's at 8.1%. And this isn't politics, ladies and gentlemen. It's just our economy is healing, and the unemployment rate's going down. That's good news. All right.
Not that 8% is anything to brag
Well,
about. But
look at the slope of that line. That thing is
better.
heading straight down. It's heading towards 6. That's what I'm predicting right now.
Whoa.
Okay. Page 4. Did you have anything, Mo?
Nope.
No.
Nope.
Page 4, I made 2 little lines, so that's not a full thought.
Oh, I
It's
thought
just
that was a happy
thought.
face.
No, it's just
Looked
a half a
face.
thought.
Oh.
And that is, there's a 30-year, chart on real gross domestic product. And last year when everyone was fearful we were double dipping or Europe was going to triple dip it or what have you.
Yep.
And that all could still happen. But look, GDP, it's kind of flicking up right now.
Flicking?
Yeah, flicking up. Just want to point that out.
Is that a technical term?
I may trademark it. Yeah.
Flicking.
That's what we do here. We do the flick analysis.
The flicking up.
And then further down that page, Mo, page 4, something called real change in private inventories. And again, people had some concerns. Inventories grew very fast after the downturn in 2009 because people had to rebuild. Companies just got a note from their bank, no more loans in the fall of 2008, so they stopped buying anything. But then they replenished as you got sort of through 2009, and then it kind of been drifting down, Businesses were waiting to see were customers going to come back, anything like that. Well, right now, real change in private inventories, which tells a lot about business expectations for, the next 6-8 months, what have you, because these things are on the water and they take time to get into the store. It's going straight up. So it touched 0, about a couple months ago, and I think it also would just give you the, hint that maybe things are on the mend, Mo.
I would agree.
That's my thought. And you can follow along, and we may be completely wrong anyway. Let's see, page 5, I had nothing.
Yeah.
Page 6. Please skip ahead if this is really.
Oh, wait a
tedious.
minute. Wait a minute. Here. Put these on.
What? Yeah.
Put those on.
Okay.
Now,
rose-colored glasses?
No, what I just put on, those are, you need the 3D glasses. You could just, next time you go take your kids to the 3D movie, bring the glasses home with you because they work on page 6 of National Economic Trends.
Oh, the colors, man.
Well, it's all 3D. Look at that.
Amazing.
It's a three-dimensional.
Consumption, imports, exports, inventories. So it breaks all the GDP components.
And it's totally,
How do they
a total
do that?
three-dimensional diorama holograph image that pops right off the page.
Does Princess Leia come out of there?
That is pretty
That's
slick.
amazing.
Pretty
All right.
slick.
Page 7.
I have a question.
No.
I do have a
Yeah.
question for you.
Okay.
Page 8.
Page 8. Okay.
We had said earlier
Yeah.
that the producer price index of finished goods,
Yes.
as opposed
PPI.
to under finished goods,
Unfinished.
it's a
yeah.
good precursor of inflation.
Could be, yeah.
So
People
here's this
predict it.
long-term chart. It goes back to 1987. And the producer price index over that, pretty much that entire time has gone from 0 to 4, 0 to 4, 0 to 4 during these different business cycles. And all of a sudden, from 1987 to 2007, trading in that tight range, this PPI went to 8 in 2008, and then went to minus 5 in 2009.
What's going on?
Unprecedented. What the hell does that mean?
Well, okay. First of all, let me preface my answer with who knows. But here's what I'll say. First of all, if you look back to these recessionary periods, they do spike up. So if you're looking at this line here,
it's way off
the
historical
up here it hit 9, but look back here. In 91, it did get to 6.
Right.
And then in 01, it got to a little over 4. So it does spike up.
But nothing like the last 2 years.
Something. I'm just going to make the point. Then 5. Now here it was 9. What happened? Well, if you remember, a couple things happened. First, the Chinese started hoarding all the rare earth metals. And so all of those things started going up. All the things that, sound, palladium and palladium and zinc and copper and all these crazy metals that you need in little pieces to go, not zinc and copper, but everything started going up. Oil went up, every commodity went up, gold was going up. And one point to make is this consumer price index is in dollars. So, the dollar, we talked about this because there's a companion piece, National Monetary Trends, which has that kind of information. But, this is in dollars. And the dollar, when you start to see that stimulus package and the money that we were spending, the United States, the spending as a percentage of GDP started to rocket. And a lot of that money, you can see from this, what happened was it just started getting into price.
But then it totally reversed itself.
And then it totally reversed itself out. So if you just had, this is the changes. So if you had a graph of the absolute, it went up, it went down, and it's back where it was. You had that spike of commodity prices kind of roll through, and it's backed off. But it was unprecedented, and I think it's because the crisis we were in was unprecedented a little bit. And when no one would loan money, when the banks said we're not loaning money, everybody just started hoarding assets. You couldn't buy them. They couldn't get the loan. There was fear that your working capital line was going to be cut. You couldn't make payroll. And there was a 2-week period or a 3-week period, where it wasn't clear what was going to happen. Lehman was going bad, Bear Stearns, the whole thing.
Remind me. Quick question.
Yes, sir.
Based somewhat on what you're seeing here, because we said this was a precursor of where inflation might go, and what's the view in your shop? Do you think, some shops are saying we're printing so much money, we're going to see huge inflation anytime soon, so they're looking at inflation hedges, and other shops are saying, there's very few safe currencies, and that's going to keep interest rates low and inflation low. What are you guys thinking in your shop? What are you guys thinking about inflation?
Well, first of all, we don't pretend to be macro economists, so we have our own guesses, but we also, think the Knicks, are going to amount to something. So,
you guys have always said that about the Knicks, though.
I know. Well, the point is, we don't try to do that. We try to value companies, but to the extent that we're sitting around the Coke machine talking about this stuff, there's been so much money. So we would be on the side of thinking that money supply growth ultimately leads to inflation, and I think Milton Friedman had that view, and he's smarter than we are, and he's pretty freaking smart, and so we kind of think in those terms. It was also an easy way to understand that there wasn't going to be deflation. So when there was a fear of deflation, the theories of Milton Friedman, now we're not economists, that, look, when you can print your own money and the rest of the world will accept it as currency, how could you possibly have deflation? You just print more money. You get inflation. You stop it. So I think, there's going to be inflation. It's right now the real rate of return, even at current printed inflation, there's an inflation number in here somewhere. It's sitting here. Look at the inflation number. It's 2.5%.
Yeah.
If I put in the money in money markets, I'm getting 1%. So there's already a negative return, which tells you that the risk premium, there's still a lot of fear because the risk premium is actually causing you to dip into principal to keep your money safe. And I think that suggests that there's a lot of fear about inflation, disruption, and it's showing up in low interest rates. Interest rates are a price to get money. And if nobody wants money, why? Because there's nothing to do with it. There's nothing to invest in. People are just skittish until they think they see how the politics and the tax rates and all that are going to roll out. There's too much uncertainty, in my opinion. That's why. So anyway, we got bogged down on page 8, which is fun. Let's keep going. All right, page. Now this chart, I thought was again, you guys all seen charts before. This is on the bottom of page 12. It's called Debt Service Payments and Household Debt Outstanding. And what I'd note about this chart, there's 25 years of data here, and it has two charts. One is debt service payments as a percentage of your personal income. So how much does your credit card bills cost you as a percent of your paycheck? And the other one is the changes in household debt outstanding. So there's 25 years. The household debt outstanding for 21 of those years was going up every year. In some years, by enormous amounts. This chart is amazing in the sense that in 2001, household debt outstanding went up 9%. In 2003, household debt outstanding went up 12%. What were people thinking? I'm sure a lot of that was probably in mortgages to buy homes and all that, and it was fueling, obviously, a run-up in price that was a bubble.
It's great while it lasted.
Yeah, I mean, if you got out, you got out. But the point to make is that number has been below zero since mid-08.
Never been down there, not since 1986.
So, people's balance sheets right now are repairing slowly. And that's, I think, why confidence is repairing. The rate of decline is coming down a little bit, so I would have to say from the slope of this chart that sometime this year people will start taking on a little debt again. But it took 4 years. I think that's pretty impressive. The other thing I'd note is that the percent of your paycheck that goes to debt service
going down
got to a high, 6 of 14%, and now it's down to 11, which the last time it was that low was in 1994. And so the period between then and now was pretty good. And so we're getting back to a level, I think, where consumers are repairing. They're starting to feel a little more comfortable. And this data might just cause me to just on a whim predict that we're going to have a pretty good Christmas this year because consumers' balance sheets are a little bit better and they're feeling a little more confidence, I think.
We'll have our Christmas stock picks for you next week, maybe.
Will we?
I don't know.
Christmas presents, stocking stuffers.
Stocking stuffers.
Okay.
Hey, how about page
15?
16?
Yeah, you're on page 16. Yes, sir. What do you got?
I want you to look at something. I've never looked at these numbers, so I
You've
just
done some calculations there,
that
Mo.
I think that was on the page
was
from
it?
whoever's looking at it before me.
Oh, okay, sure.
This is the federal budget, the deficit. I know I'm always relatively current on what the discussion is on the budget, or the deficit, but I never really looked at it from this historical perspective. So I know under the Clinton years, there was a surplus, and it was about 150 to 200. That's trillion or billion? Billion.
Those are billions.
Billion
yeah,
a
certainly.
year. So
yeah.
Good years during the Clinton years. For the next 7 years, the deficit was about 200 to 300 billion a year.
Yeah.
And listen to these. I didn't realize this. So
yeah.
You're 200 to 300 a year, and then all of a sudden, in 2008, you're minus 450, then minus 1400, minus 1300.
Well, 09,
holy,
2010, and 2011.
I'm not a Tea Party person, but when you triple a deficit for 4 years in a row, no wonder they're worried. I never thought of it in that.
No, it's enormous.
Stark of a reality.
Yeah, no, it's pretty serious. And but the good news is, look, there's a chart up here, It shows total expenditures and total receipts as a percentage of total GDP, and expenditures as a percentage of total GDP got up to 36% in 2009.
Before they leveled off.
And now it leveled off there for a couple of years. It's finally heading back a little bit. And so that does need to get back in sync.
A lot more if they're not going to. But I didn't realize that the extent of those deficits in the last 4 years.
Yeah, it's pretty enormous. But again, things are repairing, and these deficits, naturally should come down over time. They've got some explaining to do in Washington, certainly. But I think from a near-term point of view, I'm optimistic because I see the consumer repairing. I see investment going back into residential, and so the government, they're going to have to get their house in order, no question. But they'll get there. They'll get there. So,
anything else?
No, I'm hungry. I do want to say one other thing, which is thank you to again the Financial Survival Network. We had Carrie Lutz. We did a nice interview with Carrie. It's actually the Value Guys' first public interview, first live interview. Our shows are all taped here in a secret location that's my office, and but we did a live interview with Carrie at Financial Survival Network, and I think he's on WGCH on Tuesdays. I don't know the time, but go check that out in Greenwich, Connecticut. So that's all this week. I want to thank everyone for listening in to the Value Guys Stock Talk Show, and see all of our favorite stocks, ideas, indexes to past shows at www.thevalueguys.com. And thanks, everybody.
Have a good weekend.
Still have a good weekend. Please.
Actually, we thought we might just stick around until Monday and spend the weekend with you.
Let's do that.
Since this, time doesn't cost us anything. So, just keep us on and we'll spend the weekend together. Maybe we'll barbecue tomorrow.
Hey, pass the remote, will you?
We'll be there.
Yeah.